Welcome to UW-La Crosse. Welcome to the Cleary Center. My name is TJ Brooks. I'm the chair of the economics department. Thanks for coming out tonight. We're going to have a conversation with Narayana Kocherlakota, president of the Federal Reserve Bank, and I'll introduce him, but I'll take just a second to sort of thank him for being here. And one of the reasons I want to thank him for being here is one of the books that first got me interested in macroeconomics and monetary policy was this large tome, and I won't claim to have gotten all the way through it, but it's called The Secrets of the Temple, and this is really about the Federal Reserve, and the subtitle is How the Federal Reserve Runs the Country. So I have to say, given that the Federal Reserve runs the country, one of the members of the Federal Reserve system is here tonight, and we have such little turnout. I know that's being live streamed, but I think one of the reasons is because the Fed has, the secrets of the temple are out, and it's events like this where the Fed is getting out and talking about what the Fed is doing that is so important. I have another quote for you I'd like to share. It was Henry Ford, the founder of, obviously, Ford Motor Company, said, "It is well enough that people of the nation do not understand our banking and money system, for if they did, I believe there would be a revolution before tomorrow morning." So hopefully after today, after the explanations and the conversation we have, there isn't revolution in the morning, but rather there's sort of clarity and understanding about what the Fed is going to do. So with that, I'm going to introduce Narayana Kocherlakota, who, as I said, is the president of the 9th District Minneapolis Federal Reserve Bank. He comes to us by way of having spent some time at the University of Minnesota. He was also the chair of the Department of Economics there. He got his PhD from the University of Chicago. And on all your seats, you should have a pamphlet from the Federal Reserve, and it has a nice bio. So I won't spend any more time on that so we can get to your questions and the interaction that we're going to have this evening. With that, I think the way this is going to work this evening is Narayana will make some opening remarks. And then after that, we had some questions that were sent to us on a survey. We'll start with those, and then we'll work in some audience interaction when you'll text in some questions that will then display on the screen. So if I could ask Narayana to come on up here, and please give him a warm welcome.
Thanks, TJ. Thanks, TJ, for that introduction, and thanks especially to all of you for coming tonight to this town hall. It's great to see so much interest in the Federal Reserve, even after all the secrets of the temple have already been revealed. But no, so in a few minutes, I will answer any questions you might have about the Federal Reserve, or the Fed as it's commonly known, and I look forward to our discussion. But first, a disclaimer. As you'll hear shortly, I'm one of the 19 people who have the privilege and the honor to participate in the meetings of what's called the Federal Open Market Committee, or the FOMC. FOMC meetings shape the course of monetary policy in the United States. But it's very important to understand that in my remarks today, I'm going to be telling you my own views, and those perspectives are not necessarily those of any other FOMC participant. So I'm not speaking on behalf of the committee. I'm just telling you my own views about monetary policy and other economic policy. Let me begin with some background about the Fed. The Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., make up the Federal Reserve System. Our bank represents the 9th of the 12 Federal Reserve districts, and our district includes Montana, the Dakotas, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan. So as I mentioned, the Federal Open Market Committee, or the FOMC, is the Fed's monetary policy-making body. It meets 8 times per year to set the course of monetary policy. All 12 presidents of the various regional Federal Reserve banks travel from their home districts to Washington, D.C. to contribute to these deliberations, along with the governors of the Federal Reserve Board. So in this way, the representatives from the different regions of the country, the presidents of the various regional Feds, have direct input into the setting of American monetary policy. Okay, so that's how the meetings work. What are we trying to achieve when we make monetary policy? So Congress requires the FOMC to make monetary policy so as to fulfill 2 mandates: to promote price stability and to promote maximum employment. It should be clear that these are both Main Street objectives. Promoting maximum employment means that the Fed is charged with doing what it can to ensure that Americans who want to work can do so. Promoting price stability means that the Federal Reserve is charged with keeping inflation close to a pre-specified target. The price stability is invaluable because it ensures that when people write contracts today in terms of dollars in the future, contracts like student loans or annuities, they can have certainty about what those dollars are going to be able to buy in the future. So in describing this pre-specified target for inflation, in describing price stability, I've made reference to a pre-specified target for inflation. I haven't said what that pre-specified inflation target is. Using its inflation target, the FOMC weighed the cost of overly high inflation against the need to guard against potentially destructive negative inflation, so-called deflation. So this assessment has led the FOMC to pick an inflation target of 2%. And similarly, most central banks around the world have opted for a low, but still positive, inflation target. The FOMC acts to achieve its two mandates, maximum employment and price stability, by influencing interest rates through the purchase and sale of financial assets. When interest rates rise, households and firms tend to spend less and save more. That fall in spending puts downward pressure on both employment and prices. When interest rates fall, households and firms tend to spend more and save less. And that puts upward pressure on employment and prices. So that's how the Fed acts to achieve its two goals, keeping inflation close to 2% and keeping employment maximal by influencing interest rates and thereby influencing the state of demand in the economy for spending. With that context, let me turn to the current stance of monetary policy. Well, 6 years ago, in the fall of 2007, the Federal Reserve had under $900 billion of assets, and most of these were in the form of short-term treasuries. It was targeting a Fed funds rate, which is the short-term interbank lending rate, of just under 5%. 6 years later, the Federal Reserve owns well over $3 trillion of assets, mostly in the form of long-term government-issued or government-backed securities. It plans to buy still more of these over the course of 2013. It has also been targeting a Fed funds rate of under 0.25% for nearly 5 years, since the end of 2008. It anticipates continuing to keep the Fed funds at this low rate, at least until the unemployment rate, currently 7.4%, falls below 6.5%, as long as inflation remains under control. These policy actions, buying long-term assets and keeping short-term interest rates low, are designed to stimulate spending by households and firms, and thereby push up on both prices and employment. The question is the FOMC's policy stance, which is so different from the fall of 2007, providing an appropriate amount of stimulus to the economy? To answer this question, we have to compare the economy's performance relative to the FOMC's goals of price stability and maximum employment. So in July, the unemployment rate was 7.4%. And that's much higher than the FOMC's current assessment of the longer run normal unemployment rate, which is between 5.2% and 6%. At the same time, personal consumption expenditure inflation, including food and energy, is running well below the Fed's target of 2%. But this, we have to be careful here because current monetary policy is actually typically thought to affect the macroeconomy not instantaneously, but with a 1 to 2 year lag. That means we should be judging the appropriateness of current monetary policy in terms of what it implies for the future evolution of inflation and unemployment. Along those lines, after its most recent meeting in July, the FOMC announced that it expects that inflation will remain below 2% over the medium term, and that unemployment will decline only gradually. These forecasts imply that the committee is failing to provide sufficient stimulus to the economy. Let me wrap up. In my discussion about the Federal Reserve, I've described our decentralized structure, and I've emphasized our Main Street objectives of price stability and maximum employment. I see our structure and our goals as entirely complementary. my view, having people from around the country, the presidents of the various regional reserve banks, participate in monetary policy deliberations is valuable, ensuring that those discussions always put our Main Street goals at center stage. To achieve its goals, the FOMC has taken some historically unprecedented monetary policy actions in recent years. But the U.S. economy is recovering from the largest adverse shock in 80 years. And a historically unprecedented shock should lead to a historically unprecedented monetary policy response. In fact, when you look at the FOMC's own forecasts, they suggest that the committee should be providing more stimulus to the economy, not less. Thank you for your time and your attention, and I'll be happy to engage in the conversation we're about to take part in. Thanks a lot. Oh, that'd be great.
Thanks for those comments. As I said, we're going to take some questions from the audience. We'll do that by texting. I'll work those in as the evening goes along. We're going to start with the questions that were sent in previously when you registered. There was an option to send in some questions, so that's where these come from. I think they hit on a lot of the issues that we're going to want to dig into a little bit further. So the first one is, who holds the Federal Reserve Board accountable for its decisions? And this is an issue of governance.
Yeah, it's a great question, and it's a great way to lead off the evening, I think. Because who holds the Federal Reserve Board accountable for its decisions are, of course, the American public. You know, the Federal Reserve is, in fact, a creation of Congress through the Federal Reserve Act, and it's only right and meet that we be held accountable for our decisions to the American public. Now, that happens in a variety of ways, most of which are, as is true of a lot of governance situations, somewhat technical. But let me talk about what I think is the primary way, form of accountability that's out there. And that is that if you go back to 2010, in January of 2010, then Chairman Bernanke was being considered for a second term as chairman of the Federal Reserve System. So he had served a term from 2006 through 2010. And at that point, he wanted to be appointed for a second term. That was up to the President of the United States to decide, who's elected, of course, by the people of the United States, to decide whether or not the vision, the strategy that the Fed had followed under Chairman Bernanke's leadership was one that he, the president, felt comfortable with. If he had not felt comfortable with, and again, he's elected by the people of the United States, he would have gone in a different direction at that point. Of course, he did not. He chose to reappoint Chairman Bernanke. Then, of course, there's a second check, a second form of accountability, which is that appointment has to be confirmed by the Senate of the United States. There's a lot of discussion about whether the Senate felt comfortable with the performance of the economy under Chairman Bernanke's leadership and the vision that Chairman Bernanke had led the committee on. But again, after that discussion, Chairman Bernanke's appointment was confirmed by the Senate. So I think that's the main way that you see accountability working. The chairman of the FOMC is, we're all equals, but definitely the chairman is the leader of the committee and sets the course for the committee in terms of what's happening in terms of monetary policy. So that chain through the chairman being appointed by the president and then confirmed by the Senate, I think is the main form of accountability.
I think our next question concerns sort of prices. This is the one people pay attention to frequently. So they're wanting to know what's causing food prices to go up.
Right. So this is another very good question, I think. Let me talk a little bit more broadly about prices in general. So I described how the Fed moves interest rates up and down to try to influence demand. And that influences prices. It doesn't just influence food prices, though. We don't have anything that can influence one particular price. It's really we're trying to influence the prices of all goods and services at once. If we raise interest rates, that reduces people's desire to spend and firms' desire to spend today, and that will tend to push down on prices and push down on inflation. But it pushes down on all prices at once. And our goal then is to keep this a bundle of goods and services that people buy, including food and energy. We're trying to keep the price of that at growing at around 2% per year. Now, what this question asks is what is causing food prices to go up by so much? And a very short answer to this question would be food prices really aren't going up by that much. And so why do I say that? Well, if I look at how much food prices have gone up over the past year, and this is going through the Bureau of Labor Statistics measures of the Consumer Price Index, they've gone up less than 2%, around 1.4% over the past year. If you go back over a 5-year period, food prices have gone up around about 2.2% per year, pretty close to our 2% target. But I think that short answer doesn't cover it, because I get this question all the time about, why are prices going up by so much? And I think the right way to think about this is it's not really a question about prices. It's really a question about wages. I think the reason people feel like prices are going up by so much is that prices are going up by so much relative to their wages. Compensation growth in the U.S. has been very slow over the past 5 years and has been even slower over the past year. So if your compensation is not growing very rapidly, even a normal rate of price increase feels like it's very sharp and very fast. The reason it's important to distinguish these two is the treatment from our point of view as monetary policymakers may well be quite different. The fact that wages are growing so slowly and compensation is growing so slowly is really a sign of some of the problems in the labor market. The fact that employment is so low, so many people are looking for work, that puts downward pressures on compensation, and that makes goods like food seem very expensive, even if they're growing at close to the normal rate of inflation. So that means then that your target at that point, the right policy treatment is really more stimulus and not so much cutting back on stimulus, which is what would be the right treatment if prices were actually growing more rapidly than our target.
I think the next question that sort of naturally came from that is, you mentioned earlier that inflation is below target, but the question this person asks is, how is that even possible given that the Fed is sort of buying so much in terms of long-term assets? How is it possible for inflation to be so low?
Yeah, these are all excellent questions because they really get at the heart of what we're trying to do. So I had mentioned earlier that the Fed is buying longer-term assets issued by the government and backed by the government. So some of these are taking the form of mortgage-backed securities that are issued by Fannie Mae and Freddie Mac. These are essentially backed by the U.S. government. And then some of their treasuries, which have been, of course, issued by the U.S. government. I think to answer this question, one way to think about this question is to think about the problem of the Treasury. The Treasury issues, I won't get into the exact numbers, but it issues a large amount of debt per month, and more than $85 billion per month. They have to think about, do they issue it long-term or do they issue it short-term? Now, if you read carefully in the Wall Street Journal, you'll see how much they're issuing short-term and how much they're issuing long-term. Probably most of you don't pay that much attention how much they're issuing short-term and how much they're issuing long-term. Certainly, as a practicing macroeconomist, so I was a professor of macroeconomics for 20 years, it was not something I paid a lot of attention to in thinking about macroeconomic policies, how much they're issuing long and how much they're issuing short. The Fed is essentially doing what the Treasury is doing, is just switching the composition of outstanding government liabilities, the outstanding government debt, from long, by buying up the long, and then issuing, it has to pay for that somehow. And what it does is it creates, it issues deposits with banks, that is what's called bank reserves. So the Fed is just like a bank a bank for all the banks. It takes in, credits banks with deposits, and then uses that to pay for this debt. Now, what are those deposits? Those are essentially should be thought of as very short-term government debt. Why do I say that? Well, it's because of the fact that it represents an obligation, and then the interest, it pays interest. So right now, the Fed is paying interest on reserves, a quarter of a percentage point. When demand conditions improve, the Fed will, in fact, raise that interest on reserves. So technically, it's like floating rate debt, so the interest rate is adjustable depending on the Fed's choice. So a long story to tell you that the Fed's transaction of quantitative easing, asset purchases, all it is changing the maturity composition of outstanding government liabilities from long to more short. And the reason that it has only a modest impact on the U.S. economy because this is a very modest transaction. You're just changing the composition of the assets that are the liabilities that are outstanding by the government. And as I said, people never really pay attention to what the choice the Treasury is making. The Fed is just making one of those choices. We think it has a positive impact on the economy. I don't want to say there is no effect. There is a positive impact to the economy associated with this by pushing down on long-term yields, which is by buying up these long-term securities, we push down on long-term yields. That's a positive for the economy by stimulating the economy. But the effect is much more modest than this big number like $85 billion would make you think, because this is actually pretty small relative to the pool of all long-term assets in the world. You're trying to push the long-term yield of everything in the world through this lever. I mean, you're having an effect, but it's pretty minor, pretty modest.
The next question gets to the second part of the dual mandate. It starts to talk about unemployment. And they're really interested in sort of whether or not the Fed considers the numbers of people leaving the job market. The full question asked about sort of people, the labor force participation rate falling as people possibly give up on job search. And so they're wondering to what degree the Fed considers that job leaving, if you will.
Yeah, this is another great question. I cited, to start from basics, the way the Bureau of Labor Statistics reports what's called the unemployment rate. The way that's measured is they go out and survey a large number of households every month. And they ask people in those households, do you have a job? If you have a job, you're called employed. Or if you don't have a job, have you looked for a job in the past 4 weeks? They add those two groups together, and that's called the labor force. The fraction of the labor force that's in the second group, that is the searchers, the people who have looked for a job in the past 4 weeks, those are called the unemployed. And the unemployment rate is a fraction of the people in the labor force who are, in fact, unemployed. Now, there is, of course, a large number of other people who have not looked for a job in the past 4 weeks, right? So, and who don't have a job. And the question is, how do you treat those? So the Bureau of Labor Statistics reports broader measures of unemployment, of what they call, I think rightly, labor underutilization. So they'll ask questions about, okay, you haven't looked for a job in the past 4 weeks, but have you looked in the past year? And if a job would come along, would you take it? And these people are called marginally attached. Okay? So this will lead to a higher measure of unemployment. But what's very interesting is that these measures of unemployment, if you use the broader measure of unemployment, it tracks what's going on with the more usual form of unemployment pretty closely. So if you go back to December of 2007, the usual unemployment rate that you usually hear about that I described to begin with, it was around 5% nationwide. It doubled by the end of 2009. It's come down now to about 7.4%. So it's about halfway back to where it was. Doubled, and it's come halfway back. If you use a broader measure that includes folks that are marginally attached, it also doubled pretty much from late 2007 through the peak towards the end of 2009, and it's come down slowly. It's come down, has not come down as much. So the thrust of the questioner is right that if you use this measure, you wouldn't be as comfortable with the state of labor market, even as an unemployment rate of 7.4% suggests. But it certainly has come down. So it's maybe about 30 to 40% of the way back as opposed to 50% of the way back. Again, a long-winded way, it's a long answer of saying we do look at this, but even if you use these broader measures, it's telling a similar story qualitatively.
So then this next question, sort of, I've had to summarize it a lot, but it asks, are we doomed to repeat the past? The question really asks about what we're going to get back to. So there's a lot of conversation about getting back to the previous unemployment rates.
Yeah.
This person brings up the fact that the unemployment rate, when I started here, I think the unemployment rate was 3.9% nationally. It's very low. Is this what we're trying to get back to, sort of the pre-bubble era? Or what are we trying to get back to is the questioner's real question.
Yeah, this is another question that troubles us a lot at the Federal Reserve, because we know there are a lot of examples throughout history where you get to an unemployment rate of 4, for example, and you can't get back to 4 without creating huge amounts of inflation, which is certainly not what we want to do. So we try to figure out on an ongoing basis, make an estimate of where we think the unemployment rate will go to in the longer run. And those estimates change. So if you go back to the beginning of the recession I just talked about in late 2007, those estimates were somewhere between 4.5% to 5%. Now those estimates have moved upwards to somewhere between 5.2% and 6%, as I described. So what's the takeaway? We have adjusted our measures of long-run unemployment rate upwards, indicating that we do think there's been some permanent damage to the labor market associated with the recession that we just went through. just went through, ended 4 years ago now, but that we went through. On the other hand, we do think at the same time that there's considerable room for the unemployment rate to decline without having much impact on the inflation rate. And the way, there's a number of ways we try to go after this. We try looking at micro and macro data on labor markets, but a simple way to see this is the fact that compensation growth is as low as I just mentioned it is. As long as compensation growth remains that low, it's hard to see labor market pressures creating undue levels of inflation that would be putting a crimp on how much monetary policy stimulus that we could be riding the economy.
Now I think we've had a good sort of overview. I'd like to turn this over to you all. Hopefully this technology works for us. What I'm going to ask you to do is pull out your cell phone, if you have your cell phone, and text your question. The way you do this is you text to the phone number. So instead of 608-785, whatever the number might be, you use the number 22333. That's the number you're calling or texting. You prepend the text message with the number 339586. And then after that, any of the words that you put down are going to go to Dave, and Dave's going to pick the best question and put it up here for us. So pull out your cell phones if you have them. If you have a question, we'll take it now. It'll take you a few seconds, unless you're like some of my students, in which case there's probably already a question over there. So as we wait for sort of that question to come in, I'm curious as to sort of a little bit more detail on the structural damage you sort of referred to. I've got a few colleagues that are labor economists and doing some of these surveys on applicants that have been out of the job market for a while and how long it takes them to get rehired. What are some of the things you're seeing that are sort of the causes of this permanent damage?
I wish I had better answers to that, TJ. I mean, I think that I think you see sort of the imprint of it, the shadow of the damage, as opposed to knowing necessarily what the source of the damage is. One way to see, I think, some of the imprint of it is that the so-called beverage curve has shifted out so much. This is a curve that is just describing how the unemployment rate, which I've already talked about, and then the job vacancy rate is moving over time. And it just seems harder from that curve, when you look at it, it seems harder for vacancies to be turning into jobs. So one way to say that is the job vacancy rate has gone up a lot relative to mid-09, the end of the recession. The hiring rate has moved relatively little. So there's something going on. One theory I think is quite plausible for this is, this isn't structural damage. This is just the fact that the employers don't have good demand for their products. They feel like they should be searching, but they're being really picky. They only want the cream of the crop. Okay. Whereas in 2007, they were less demanding when they were filling vacancies. And so if demand improves, they'll be less picky. I think that's definitely plausible, but I think when you talk to employers, I think there's more to that than that going on. So another way we see this is also from the fact that I've mentioned how low inflation is. It's been puzzling in some sense how high inflation is. Given how high the unemployment rate is, we would have expected to actually see even more downward pressures on inflation. That's just another sign that there has been some, I think, structural damage to the labor market.
I think we got one.
Really a test for Dave, I think.
He passed.
Whoa.
So what's a typical meeting like for the FO, and I'll help you with the texting, FOMC. I think this is interesting to sort of inside the temple. Tell us a little bit about how a meeting goes, since we don't get a seat at the table.
Sure. It's much more structured than you might think. So let me talk about how it's structured. So a typical meeting will have begin with a staff presentation about the economy. And so the staff will present what they see is happening in the economy, and then also, also what their forecast for what's going to happen going forward. After that presentation and questions of staff, there will be a go-round, an economics go-round, where each FOMC participant speaks in turn. So each president will speak first, and then each of the governors will then speak. Presidents will relay some information about their local economies, but will also speak about national economic conditions. Chairman Bernanke usually speaks last. The chairman is remarkable in many respects, but he has an amazing talent to summarize these 19 voices that he's heard into a coherent whole. And then and then provide a color of his own on top of that. I guess he's heard 18 voices, then his own voice would be the 19. After that, there is a presentation about policy options. Staff will make a presentation about policy options. And there will again be a go-round where every participant speaks in turn about those policy options and how the participant sees those. And again, the chairman will summarize that discussion, and there will be a vote among the voting members about whether or not the statement as written by at that moment in time. There will be usually changes in language and such that have been suggested throughout these go-rounds. But there'll be a draft that'll be considered at that point for a vote, and if it gets a majority of the vote, then it becomes the statement that guides policy going forward.
I think we'll bop back to some of the pre-questions, but we'll come back to asking you some more questions in a second here. The next one is sort of asking about what real impact that monetary policy has on Main Street. There are really two questions here. One's asking about, if the Fed wasn't doing what it's doing, would the country be better off? Sort of what effect is the Fed having on Main Street America?
Yeah, I mean, as I indicated in my opening remarks, our objectives are all about Main Street America. So we're trying to keep inflation close to 2% and keep employment high. So how are we doing that? So this question, if you look at the bottom, it's talking about large-scale asset purchases. So we're going out and we're creating these reserves, these bank reserves. These are the short-term liabilities that I've described that in order to finance the purchase of longer-term assets. Now, why are we buying these longer-term assets? We're putting downward pressure on interest rates, longer-term interest rates. That, in turn, when you buy mortgage-backed security, when we're going out and buying a mortgage-backed security issued by Fannie Mae and Freddie Mac, that's almost automatically putting downward pressure on mortgage rates being paid by households. That's a form of stimulus because people can refinance then, they'll have more cash in their pockets, or they can be able to afford to buy a house that puts upward pressure on housing prices. That's another form of stimulus. So that's, but as well, these downward pressure on interest rates feeds into a number of forms of interest rates around the economy. Usually people emphasize the borrowing channel, so when you go to buy a car, the car financing will be cheaper. More people will buy cars. That'll put upward pressure on car prices. And it'll make people should feed that with that extra cash in their pockets that I described from the mortgages, and also the upward pressure on car prices. That means that the automakers want to hire more workers to make cars. That's good for employment. And and as well, people are going to spend more. Everybody wants to produce more than to fill the demand for goods. So these are all actions by manipulating interest rates, pushing downward on interest rates, trying to stimulate demand, and thereby push upward on prices and push upward on employment.
As someone who's looking to build a house 2 blocks off of Main Street, I certainly appreciate the lower mortgage rates. I wish I would have locked in May. Some of you don't follow interest rates as closely as I do, apparently. That would have just killed among a bunch of economists, wouldn't it?
That would have been hilarious, TJ.
Thanks.
Yeah.
So, the next
Tough crowd.
Yeah. And the jokes don't get any better, folks.
Yeah.
So how long do you see us continuing this policy, this sort of interest rate policy that we have going on?
So it's not really about a length of time. It's about keeping it in place until we see sufficient improvement in the economy. So it's about conditions. And what the Fed has communicated about this is that it intends to keep the Fed funds rate, this interbank lending rate, extraordinarily low, near zero essentially, at least until the unemployment rate falls below 6.5%. As long as, you don't want to just make commitments to unemployment, you have to keep in track of inflation as well, because if inflation got too high, this would be a negative from the point of view of what we're trying to do. And so we also say that as long as the unemployment rate, at least until the unemployment rate falls below 6.5%, as long as the outlook, 1 to 2 years out for inflation, remains below 2.5%. So that's close to our target, right? 2% is our target, 2.5% is it would be a little bit above to allow for the fact that we're missing so badly on unemployment. So at least until then, right? Now, I think a question the Fed has left unanswered in its communications is, what will we do with interest rates after the unemployment rate falls below 6.5%? Now that, how long is it going to be before we get to unemployment rate of 6.5%? That's really up to the private sector to forecast. The whole point of formulating policies in terms of economic variables like this is you shouldn't have to rely on our guesswork about how long the unemployment rate is going to stay as low as it is. The private sector forecasters can figure that out and price that into bonds accordingly. I think the problem with the Fed's policy is that so far is we have not communicated effectively about what's going to happen once the unemployment rate falls below 6.5%. Are we going to keep rates extraordinarily low, or will we start to raise them? How fast will we raise them? That uncertainty, I think, is contributing to some of the upward pressures on interest rates that TJ described himself as struggling with in the last 3 months especially. I think markets have become uncertain about what we're going to do after unemployment rate falls below 6.5%. Will we move sharply, or will we continue to keep the recoveries back, as it were, by keeping rates low?
You missed your opportunity to take and pat the Fed on its own back. So you said that it's up to private forecasters to forecast only. Most of the research suggests you guys are better forecasters.
You know, that's true, of course. But no, I know. But I think I think it's important for us to be formulating, in a serious vein, I think it's important for us to be formulating policy not in terms of length of time, but rather in terms of economic conditions. And the reason that is it allows you to know that the Fed stands about to what extent we have the economy's back. And what do I mean by that? If there was an adverse shock to the economy, you'll know that, boy, it's going to take longer for the unemployment rate to fall to 6.5%. That means the interest rate is going to stay low for longer than you would have expected otherwise. So that means we're automatically providing more stimulus to the economy without having to make a move at all. Right? Just your change in the forecast based on an adverse shock is automatically adjusting stimulus. And that actually insulates the economy against shocks. People know that the economy is insulated against shocks through monetary policy. I think it's a very positive development.
So here's another question that asks kind of a follow-up. Is it a good idea in the long run for the Fed to keep interest rates artificially low?
Well, the answer is no. But I think that the question, I think it's important when we answer this to answer the question according to what the word artificial means. I think about artificial only in terms of how we're doing on our objectives. So right now, interest rates are artificially high. Why do I say that? Because unemployment is too high, inflation is running too low. That means we're not providing enough stimulus. Seems like interest rates are actually not artificially low. They're, in fact, artificially high. Now, and I think when people ask this question, what they have in mind is, boy, interest rates have been low for a very long period of time. Or they might be thinking, interest rates have never been this low before. Why do you have to have interest rates this low? And I think the right analogy when you think about this is to think about, or at least the analogy I find helpful. Economists always find weird analogies helpful, but this is one I find helpful. Is really in terms of winter clothing. So, if you just looked at, suppose you see somebody walking outside and it's May and they're wearing a parka. You might say, you're wearing artificially too much clothing at that point. Well, that wouldn't be true in Minneapolis. We had snow in May in Minneapolis. So you should be wearing a parka in May in Minneapolis. So it really depends on what the conditions are that you need to wear, what kind of clothes you need to put on to keep yourself warm. The interest rate, the analogy to the parka in my example is the interest rate. And then it really depends on what the conditions are, not the time of year or how long it's been and all those things. So I think the issue of artificial, of course not. You should not keep interest rates artificially low. Should we be keeping interest rates low in order to achieve our objectives? Yes. Have we made them low enough? No.
So I'm completely stealing that analogy for class, if you don't mind. I have sort of a follow-up question on that. To what degree what should you look at to sort of identify the stance of monetary policy? But a lot of these questions have focused on interest rates. They're focusing on sort of short-term nominal interest rates. In other words, should I be looking at the clothes you're wearing to infer monetary policy stance, or what should I be looking at as someone in the economy to infer monetary policy stance?
Well, we want people to be keeping track of interest rates so that they know whether because that's our instrument by which we provide stimulus. So we want people to be looking at interest rates and thinking about how long they're remaining low and what the conditions are we're going to be keeping them low, what they're going to be guiding our actions. But that's not the way to judge the appropriateness of what we're doing. You want to be keeping track of that in order to decide whether to buy or build your house or not. I mean, that's economics. So that's just, you should be doing that in your own private interest, frankly. You should be keeping track of interest rates and making your decisions. But that's not the way to judge whether or not what we're doing is appropriate. And the way to be judging that is through our outcomes. We've said that we're trying to keep inflation close to 2%. Well, how are we doing on that? If the outlook for inflation looks low relative to 2% going forward, we're not providing enough stimulus relative to that inflation target. If unemployment is as high as it is, and it looks like it's going to stay as high as it is for several years, well, again, we're not providing enough stimulus in that dimension. So the appropriateness of stimulus, you should not be judging it, importantly, by, well, what do interest rates look like now compared to what they looked like in 2005? That wouldn't make any sense, because the economic conditions we were dealing with are so different from 2005. The way to judge the appropriateness of policy is in terms of how we're doing on the outcome front.
So this next question, I'm sure, is from a group that doesn't exactly appreciate low interest rates as much as I do. So why are you punishing the elderly citizens who primarily use CDs for savings?
Yeah, I mean, the monetary policy is a tool that is designed to achieve these macroeconomic objectives that I just described, inflation and unemployment. And it's definitely a tool that has distributional consequences. Somebody who's primarily using commercial deposits for savings is going to be hurt by keeping interest rates low. Somebody who's using it has an annuity instead will be helped by keeping interest rates low. Especially if inflation's running as low as it is, that's going to be good for somebody who's got an annuity. So, so there's going to be distributional consequences. I think that the way I think about these kinds of questions, though, is that the Fed is merely responding to economic conditions itself. We are facing the same environment that the elderly citizens are mentioned in this question are facing. The problem we face is this. After the recession of 2007, the financial crisis that took place 5 years ago, people are nervous and uncertain, and they want instruments for saving. They want to save. This is not just people in the United States. Everyone around the world wants to save, and they want sources of safety. They don't want to save by buying a random mortgage-backed security that's issued by some Wall Street firm now. They might have been happy doing that in 2005. They want to be issuing something that's safe. They want to be buying something that's safe. And everyone wants to do that. That's why we have to lower interest rates as much as we do to try to hit our targets. And that's why the interest rates that you face as somebody who's saving, if you try to do the same thing as everyone else in the economy, you always pay a high price and go to low return. That's what's happening to these poor people is everyone else is trying to do the same thing they would normally want to do anyways. And so they're going to have to pay a high price, which translates into a low yield. And the thing we need to get to is a more secure world, a safer world, where people don't feel this such a pressure to save for the future.
I think we have another question for the audience. Dave's going to throw. Good. So what advice would you give to aspiring economists?
Well, I think it's a great field to get into. I think TJ mentioned I got my PhD in economics in 1987 and went into academia. I think it's a great time to become an economist, but I think the important thing is you have to take some math. It's a part of the language we use in economics is mathematics. But really, you shouldn't see it as too much of a hurdle. It's just it's like having to learn a foreign language that you have to get under your belt. And once you get it, it's not that hard a language to pick up. Because the math isn't the interesting part. The economics is the interesting part. The math is just the language. And why do economists have to use this language? Why do they speak this way instead of in English? It's a great question. I mean, I think it's easier to check each other's work in math. You know, when people make statements in English, sometimes there can be slippage, and what seems logical to one group of people might not seem logical to another group of people. In the mathematics, there's no controversy about that. So that's why I think economists are drawn to using math. But the math is actually fairly simple. You have to take a little bit of math. Once you learn it, then it opens up a whole wide range of questions for you. I think so. If you want to be a practicing economist, I think it's good to go on and get graduate work beyond your undergraduate degree. I think that getting a PhD is a good thing to be doing. It might seem that's usually the coursework is hard in the first year, but then after that it opens up. I think what's really exciting in economics right now is sort of the questions on the macro front are really very challenging and important ones for the whole world really we're facing. But on the micro front, just the immense amounts of data that have become available over the last 15 years. The big sea change since I got my PhD over 25 years ago is the availability of data, the ease with which you can download and think about using that data, the ability to craft quasi-experiments in that data. It used to be you could never think about doing an experiment in economics. Now people do them routinely, not just in the lab, but actually out there in the real world. This is, I think, really building our knowledge base in a very, very nice way. So I think it's just a very exciting time.
I think you scared a few of them with the math comments, by the way. So what did Marshall say? Do the math, explain it to your mother, and then burn the math? I think is sort of how we're supposed to operate. Some of us forget to burn the math, I think.
My mom was a statistician, so it would have been...
Now you understand everything.
Yeah, exactly.
I'm going to skip ahead to a few questions because I want to get to one of these sort of questions in terms of reliving the recession or sort of putting it off, hopefully. So why is there still too big to fail banks holding nearly 2/3 of the commercial banking assets? We have some large banks that seem to be too big to fail yet. Where does the Fed stand? Where does the regulatory process stand on that?
So, I think that this is a great question again because I think it shows the power of words and the imprecision, the power that lies in the imprecision of words. That I think the term "too big to fail" is actually a somewhat misleading one. So I think the problem really should be identified as too dangerous to fail or too systemic to fail as opposed to too big to fail. And they're not necessarily the same thing. You can imagine a bank that would be very easy to resolve, and I'll explain what I mean by that in a second, that would be very, very large. And yet a bank that's much smaller that's doing something systemically important for the economy that you couldn't easily transfer that activity to some other institution, that would be a bank that would be too systemic to fail. An example of such a bank was in 2008, in March of 2008, an investment bank called Bear Stearns failed, but actually the key activities it was doing were taken on by JP Chase, but that transaction was facilitated by an infusion of resources from the Federal Reserve. Why did that infusion of resources take place? It's because that market activity that Bear Stearns was doing, even though it was only the 8th largest bank in the United States at that point, was viewed as being too systemic to allow that bank to fail. So I think the term "too big" is really not really the right one. It's really all about being too important, too systemic. Now, how do we guard against these systemic banks, try to prevent them from failing? I think that's not the right way to be thinking about it is in two ways. One is on the ex ante, the before side, and the other is on the after side. On the before side, we want to be able to identify these problem institutions ahead of time, and this is now done through what's called the Financial Stability Oversight Council. This didn't exist in 2008. And we have to be having good supervision and regulation over these institutions, and we have to be making sure they have enough capital. So what does capital mean? It means that they have enough people who hold stocks in these firms that their stock prices any shock can be absorbed by the stockholders as opposed to being transferred over to the debt holders when you start to get bankruptcy and failure of the institution. So you have to make sure there's enough equity or what's called bank capital in order for these firms to be safe. So how do you do that? The Fed runs what's called stress tests on an annual basis. It really puts these firms through the ringer of a really adverse scenario or shock and makes sure that they have enough capital in place to withstand that kind of shock. That's all on the before side, making sure that even a bad shock would leave these firms safe. On the after side, and you can never be perfectly sure on the before side, on the ex-ante side. On the after side, I think there was great changes in legislation that was passed in July 2010, the Dodd-Frank Act, to make resolution more smooth. So the problem I just went through with Bear Stearns was you couldn't just fail the institution without worrying about making sure that one of its market activities that was critical for operation of financial markets around the world would continue on, could fail on a Friday and have those run on a Monday. So what's being done now is what's called the living will process to make sure that regulators and firms have a clear understanding of what their activities are and what would happen in case they died. That's what living will means. So they're trying to formulate a plan of attack to make sure their essential activities can be safely undertaken by some other institution in case they do fail. So that's a long answer, but it's really not as long as the Dodd-Frank Act, which is 835 pages. So terse in some ways.
So a follow-up to that is sort of, you mentioned some things, but what's been done to prevent a repeat of the 2007 recession?
So I think we can, I pointed at some of the things we have done, and I think that those are good moves. That recession was associated with problems was associated with the failure of a large banking institution, Lehman Brothers, that was undertaking a large amount of very systemically important activities. It failed, and that created a financial crisis that really caused a very bad recession, not just in the United States, but around the world. You can never prevent recessions completely, I don't believe. We're always going to have a business cycle with this. I think what we have to guard against, more than anything else, and it troubles me the most, is I think right now there's still a feeling of insecurity about the recession, about what happened, and people are worried about the banks. And the last question posed the question about, boy, aren't the banks still too big or too dangerous? And so you see everyone concerned about that. I think the important questions are going to be come at us 15 years from now. And the questions are going to be, you might see housing prices rising very rapidly at that point. Everyone's going to feel like, boy, I've got a lot of equity in my house. And the banks are going to feel like, I want to get in on lending to these people because, boy, their housing equity is their housing prices are going up a lot. What are regulators going to do then? What are the American public going to do then? Are they going to be happy with the regulators clamping down on the banks at that point? I think those are the key questions. And I think there's a great book by Carmen Reinhart and Ken Rogoff, two economists at Harvard, called This Time is Different, which is a sarcastic reference to the fact that these housing appreciations and bubbles and then financial crises have happened periodically over a period of 8 centuries. Actually, if you go back to read Tacitus, if you go back to Roman history, 33 AD, you'll see an example of a financial crisis. So it goes back a long ways. And what's important is that for us to take on board the lessons, not just in terms of building up the structure as I just described, but to be able to play according to the rules of that structure when we feel safe, when we feel complacent. I think that's the challenge. And that's somehow this time is different is really being able to recognize, no, this time is not different. And I'm hoping that we'll be able to do that.
Let's see if we can take a turn for something a little bit more optimistic. We'd like to know sort of, where do you see the U.S. economy 5 years from now?
So I think that, so I'll talk first about my own goal, the goals for the institution I represent, the Federal Markets Committee. Our long-run goals are for inflation to be around 2% and for the unemployment rate to be between 5.2 and 6%. And I do see the U.S. economy achieving those goals. I think I'm optimistic that it'll achieve those goals before 5 years from now. So I think that's the positive on that front. I think there are more uncertainties, so you want to be optimistic, but there are more uncertainties on the employment front. So I described that the unemployment rate be between 5.2 and 6%, and we talked about how you define the unemployment rate. I think it's not as clear what fraction of people will have jobs in 5 years. I think it'll be more than we have them now, for sure. I don't think it'll be as many as had them in 2007, simply because the population is aging. So, but How big that will be, I think, is more uncertain. But I think the unemployment rate and the inflation rate will normalize. I think a more interesting question, when I think about this question, is really looking over the longer haul even. I mean, 10, 20 years down the road. And I think there are two competing two forces that are very important over the longer run. One is demography, and one is technology. The demography is really about the fact that we had this group of people who were born between 1946 and 1964, baby boom, that cohort. They're going to be moving through the population. They're going to be, more and more, they're going to be retired. They're going to be living a long time. They're going to need health care. They're going to need resources for that health care. That's going to puts stresses on the society because there are relatively few people working now. They have to provide for themselves by what they produce and provide for those who are not working. So that's the demography aspect. And some of this is framed always in terms of how do we finance it through Medicare, et cetera. This is part of the issue, but actually it's not the whole. I didn't frame it at all in terms of the government, right? I just framed it in terms of we have a relatively small group of people working and a relatively larger group of people not working. We want to keep those people going in a relatively comfortable existence. That means that we're going to need more out of those people who are working to be able to do that. So where does that come from? That comes from technology. And we've just seen Dave use technology here. So technology is great. It's been with us for the last 200 years. It's what's helped our living standards rise steadily over that time frame, over longer than that. But technology has been systematically skill biased, which means, roughly speaking, the more educated people have profited by technology more than less educated people. And that means that we as Americans are only going to be able to take advantage of this technological ride upwards to the extent that we keep educating our population at get those relative educational attainment growing upwards. I think we, as a country, haven't done as good a job on that over the last, say, since 1990 or so as we could have. Our rates of educational attainment have lagged a lot of other countries in terms of over that time frame. I think we see some turning of that in the last 3 or 4 years. I think that's a positive, but we can't get complacent on that because that's really where that's how you solve the demographic problem, is by having enough technological growth and enough people can take advantage of technological growth. Then you can start to solve that problem.
I think that's about as optimistic as economists get sometimes.
That is, yeah.
I was going to follow up asking about Robert Gordon's hypothesis, but I don't want to press us again. So I think it's 8 o'clock. I think we'll end there. If you can all join me in thanking Narayana and the